Hi, everybody. Thank you so much for being here today. Very excited to share with you the results of our PEA last week. So thank you for coming and taking the time to join us this morning. Before I begin, I'd just like to draw your attention to the forward-looking statements on this slide. Today's presentation includes information regarding the company's plans, expectations, and future development. So I just encourage you to review the disclosure. All right. Our flagship asset is the Ruby Creek property. This is a 30,000 hectare district scale land package located just outside of Atlin, British Columbia. So what makes Ruby Creek unique is that it offers two distinct opportunities within a single property. The first is obviously the Adanac Molybdenum Project. It hosts a 436 million pound moly resource that was previously advanced through feasibility, environmental assessment, permitting, and into early construction prior to being halted by the 2008 financial crisis. So what that left behind is significant. It's over $100 million invested in roads, drilling, engineering, and infrastructure, and I'll come back to why that's important in just a few minutes. Briefly, the second opportunity is the broader exploration potential on the Ruby Creek property. So we've identified multiple mineralized systems, including high-grade gold and silver veins with visible gold at surface, copper-gold porphyry target, and meaningful tungsten exploration, all providing additional long-term optionality beyond the Adanac development story. But importantly, today's presentation is about this major milestone that we reached last week with the release of the preliminary economic assessment. So for the first time since 2008, we now have an independent study that demonstrates that Adanac is a large-scale, long-life primary moly development project with robust economics and a clear path towards feasibility. So that's really what I'm here to walk you through today. I'm going to just start with the foundation of the asset first. So today, as I said, we have a 436 million pound measured and indicated moly resource. I'll spend the next few slides digging into the economics, but before I do, I just want to come back to that more than $100 million spent on the project in the past. That investment wasn't just money spent. It establishes a foundation for the project that we get to benefit from today. The feasibility work, the environmental assessment, permitting, and early construction significantly reduced work, time, and capital required to advance the project to the next stage. More importantly, it demonstrates that Adanac has already overcome some major hurdles that development projects will face. From a strategic perspective, Adanac is road accessible. It's located 35 kilometers from Atlin and 275 kilometers by road to the port of Skagway, combined with a favorable 0.7 to 1 average life of mine strip ratio. These are meaningful competitive advantages that differentiate Adanac from many development stage projects. So with that foundation established, the next question comes, well, how do we compare? How does the market compare us to our peers? So this slide highlights what we see as one of the largest disconnects in the story today. EraNova is trading at roughly 2 cents per pound of moly in the ground, where comparable development stage projects trade anywhere from 14 cents to more than $1 per pound. Now, the discount itself isn't what stands out, it's the magnitude of it. The market hasn't recognized the value reflected in the project's development history, the existing infrastructure, permitting foundation, or the broader exploration optionality across the property. So the PEA is really an important milestone because it independently validates the project's economics and reinforces what we've believed all along, that the underlying asset is worth more than the market's valuation today. So with that context established, let's look directly at what the PEA demonstrates. So using a long-term moly price of $25 US per pound, the study generated an after-tax NPV of $714.4 million, a 23.5% after-tax IRR, and a 2.6-year payback. So what I like most about these results isn't any one metric, it's the overall balance. A strong NPV, an attractive return, and a relatively short payback together support advancing the project towards feasibility. At today's spot price of $32 per pound, those economics improve significantly, which demonstrates that the project has leverage to higher moly prices. Operating fundamentals also demonstrate the scale of the project. So this is a 30,000 ton per day operation with a 24-year mine life. Projects of this scale are inevitably going to require meaningful upfront capital, but they also have the ability to generate significant long-term cash flow. And that's really what this PEA demonstrates. So the upfront capital is represented in the 949 million CapEx, but it does speak to the size of the project. So these are the headline numbers, but really the next question is, how do we achieve them? So the mine's designed at a conventional open pit operation, 24-year mine life, processing 252 million tons over that period. One of the key drivers behind these results is the mining sequence. So as you see in the graph on the right, the operation is developed through a series of pushbacks. And this allows us to access the higher grade, lower strip ratio material first before progressively expanding over the life of the mine. So that strengthens the early economics by moving less waste for every ton of ore mined. And that supports the stronger cash flow and faster payback of that initial capital. So even over the life of the operation, the average strip ratio is just 0.7 to 1, which is a very favorable ratio for a project this size. The operation is expected to produce 11.4 million pounds of moly per year, totaling 274 payable pounds of molybdenum. So next question is, how efficiently can we recover that moly? What's great about the study is that the metallurgy is quite straightforward. It's based on a conventional flotation process that's well understood across the mining industry. And that reduces technical complexity from both an engineering and financing perspective. The study demonstrated a 90.2% moly recovery, meaning that we're recovering the vast majority of the moly contained in the ore into a sellable concentrate. So taken together, the metallurgy enforces what we've seen throughout the PEA, a technically straightforward development project built around proven mining and processing methods. So we've looked at the technically straightforward development project, but I want to get into the details of what it costs to build and operate a project of this scale. So the initial capital requirement is $953 million. And it's important to view that in the context of what's being built. This is a 30,000 ton per day operation with a 24-year mine life. And it's expected to produce 270 million pounds of payable moly. So projects of this scale require meaningful upfront capital, but they also have the ability to generate meaningful long-term cash flows, which is what we've seen in this study. Importantly, this isn't a typical greenfield project. All that previous investment in drilling, engineering, permitting, infrastructure, and early stage construction gives Adanac a significant head start as we advance to feasibility. I think it's important to consider not just economics, but the practical realities of building a mine. Infrastructure, permitting history, and access all help reduce that development risk, and those are meaningful advantages that we have here. So naturally, one of the biggest questions for any project is commodity price. So I'll look at how it performs under different price scenarios here. Everything that we've discussed so far is based on a long-term moly price of $25 per pound, which is well below the spot price of $30 US per pound. But one of the first questions we ask is, what if the price of moly isn't $32 forever? And that's why the study is based on a conservative long-term price assumption. So even at $25 per pound, the project demonstrates robust economics. At today's spot price, the after-tax NPV increases to 1.3 billion, while the IRR increases to just over 30%. And I think that highlights the project's leverage to higher moly prices. It's also important to remember this is a 24-year mine life. So projects of this duration are designed to operate through multiple commodity cycles and not a single point in the market. So while the forward moly market is relatively short dated, as the project advances, we'll evaluate commercial structures such as long-term offtake agreements to help manage that commodity price risk. So ultimately, the analysis demonstrates two things here. The project works at a conservative long-term moly price, and it provides meaningful upside in a stronger pricing environment. Next slide is the resource. The updated resource is very similar to the previous estimate, so there really aren't any major changes to highlight. But what is important is that 93% of the resource is supporting the mine plan that is in the measured and indicated categories. So that's a very high level of confidence for a PEA and means we're not relying heavily on inferred material to support the economics. Now that becomes increasingly as important as we move towards feasibility because it reduces the amount of additional drilling and technical work required, lowering both time and capital needs to reach that next development milestone. So we've established that Adanac is technically sound, economically robust. The other half of the investment thesis is, why do we think that the timing is so compelling? The long-term fundamentals for moly are becoming increasingly compelling for two reasons. First, demand continues to grow. It's expected to increase from about 660 million pounds to 850 million pounds over the next decade. And that's driven by infrastructure, electrification, and high performance steel applications. The second is an important one. So new supply is difficult to bring online. About 90% of Western moly production comes as a byproduct of copper mining, meaning much of tomorrow's supply depends on new copper mines being developed, which is a process that takes years. At the same time, there's very few advanced primary moly developments outside of China. And so where does that supply come from? And that's exactly where we see Adanac fitting into the picture. Projects like Adanac take time to establish. So the engineering, permitting, and technical foundation required to reach this stage simply can't be created overnight. We've seen moly metal prices increase from US $10 per pound to over $40 in 2020. $10 per pound in 2020 to over $40 per pound of moly metal today. And so that reflects the stronger market fundamentals we've just discussed. Commodity prices will move through cycles. That's the nature of mining. What it doesn't change overnight is the availability of advanced development projects. And I think that's really what makes Adanac stand out. It's not just the quality of the project or the strength of the moly market. It's the combination of an advanced development project with clear, relatively low capital path forward to feasibility, entering the market that increasingly needs new moly supply today. So the PEA represents this important inflection point for the company. It independently validates the economics and provides a clear roadmap towards feasibility, which is our next major milestone. But from here, what are the next steps? Our priorities are pretty straightforward. Advance feasibility, further de-risking engineering and technical aspects of the project, continue permitting and environmental work, building on the foundation that was already in place, then building the technical team required to advance a project of this scale. Furthermore, the PEA gives us the ability to pursue government funding that are available for critical mineral projects like ours and have advanced discussions with strategic partners, financing groups, potential offtake partners. So each of these initiatives reduces different elements of project risk, technical, permitting, execution, financing, commercial. Together, they really continue moving Adanac towards a construction-ready asset. So good projects attract good people, good partners, good capital. Our job here is to continue to systematically de-risk Adanac so that with every milestone, the project becomes increasingly attractive to the broader universe of technical talent, strategic partners, funding sources, and investors. And the PEA is really a significant step in that process. I mentioned earlier, I'll take 2 seconds to touch on the exploration upside. This is some optionality that we have here. So while the presentation is really focused on the PEA, one of the things that does make our project unique is that it isn't just a moly project. As I said before, we've identified multiple mineralized systems, including high-grade gold and silver veins with visible gold at surface, copper gold porphyry, and some really meaningful tungsten that has the potential to add value to the existing moly project. So as we advance towards feasibility, we'll continue to evaluate opportunities across the broader property to increase additional long-term optionality and value for shareholders. So when you put all these pieces together, you've got a completed PEA demonstrating robust economics, a clear path towards feasibility, meaningful exploration upside across the broader property. We believe there's a disconnect. I mean, there is a disconnect in the valuation today. We traded at about an $8 million market cap, which doesn't reflect the stage, the quality, or the scale of the asset that I've just walked through. We have 56 million shares outstanding. Strong shareholder base with meaningful insider ownership, including Eric Sprott as our second largest shareholder. And we have got an effective float of roughly 30 million shares. With those things in mind, that cap structure provides meaningful leverage as we continue to execute against the milestones that I outlined. So I'm going to leave you with the investment thesis. We have a 30,000 hectare district scale property with significant historical investment in infrastructure, engineering, permitting. And that foundation really provides a proof of concept that this project can go through the major milestones required to become a mine. On that same property sits a large scale, that property sits the large scale long life primary moly project with a completed PEA, and that demonstrates robust economics and a clear cost-effective path to feasibility. It also hosts exploration upside, providing additional optionality in the long term for investors. We have 56 million shares outstanding, strong insider alignment, and an $8 million market cap. So the PEA demonstrates the quality and the value of the underlying asset, and today's valuation doesn't reflect it. And that's really the disconnect that we believe represents the opportunity today. So thank you so much for your time. Happy to answer any questions.
Thank you very much, Meredith. As a reminder, everyone, if you do have questions, you can add your question to the Q&A using the Q&A box along the bottom toolbar in your Zoom screen. We have 2 questions currently. We'll start with the first one. The question is, why is EraNova trading at a significant discount to moly peers?
Good question. I mean, we know that development projects can trade below NPV, and that's to address engineering, permitting, financing risks, and that's quite normal. But yes, EraNova does trade at a large discount when compared to primary moly projects, despite the quality of the asset. So I think a piece of it is a lack of understanding of the value of the asset that we have, which is part of the execution that I'm tasked with and working on. And so really that's my job right now is to keep executing, continue to build market awareness and close that valuation gap.
Second question and final question at this point in time. Can you tell us what's been done or is planned to increase awareness of your company within the Yukon's business community?
We have within the Yukon's business community. Well, ultimately, we're based in BC, and that's the First Nations community that we're working within. So those are conversations that are ongoing. The Yukon business community, I think, is an important one for us, given that we are so close to the Yukon. Again, the PEA has been a significant inflection point for us to be able to advance any of those conversations, whether that's strategic partnerships, government funding, offtake partners. So this PEA really lends to the ability to start moving that forward, but it's very early days in terms of communicating with the Yukon business development entities.
We have a couple more questions that have come in here. Firstly, has the company been approached by somebody to take a stake in the company or contribute financing?
If we had, I wouldn't be able to speak about that publicly because that would be material information. But that's certainly something we're always looking. I mean, we're a junior exploration company with a development asset. So capital is an important piece of moving the project forward. And so those are conversations that we are initiating and engaging with because capital will be a significant part of moving things forward.
And a final question. Could you outline the path forward to further unlock the value over the next 17 months in terms of the steps, both at Adanac and at the Atlan exploration targets? Any budgets set at this point?
I think, yeah, I can outline steps. I mean, going back to our slide on steps forward, I think right away we will be looking at financing opportunities, given the size of where we're at and the potential of where we can go. That can lend to more institutional conversations. So capital raising conversations. I'm actually going to be attending the International Moly Association AGM, and there will be opportunities to have conversations with potential offtake partners or strategic partners on the sale side. So companies like Freeport and Centerra and MolyMet, these are all individual companies that we would have interest in speaking with as they're the end users that would ultimately want our concentrate. And I think that having MOUs like what Greenland has done is a great way to show de-risk and show add value for shareholders. Marketing is obviously an important piece, getting the story out. The comment with regards to being an $8 million market cap is an important one. But I really think that speaks to the opportunity that we have. And the opportunity that exists for shareholders. We have this amazing asset, and I believe that good projects attract good people. And so we have a great project, and so we're really trying to ensure that more and more people know about that. Did I answer every part of that question, Fiona?
I believe so, yes.
Okay.
I guess the other question was if there were any budgets set at this point.
Oh, any budgets yet set at this point? Moving towards feasibility, we'll probably have a $10 million ticket on it just between permitting and EAC considerations and feasibility. So whether it's obviously all in context to the market, but that would be a next large milestone of financing that we would want to consider and look into and work towards.
And if you could just speak to the next steps for Atlan as well.
Oh, sorry, next steps for Atlan. Yeah, so really our focus right now is on the development story. But the exploration does add a lot of value, optionality on this broader land package. So ultimately, it comes to budget and it comes to time, but we are exploring all the potential abilities to add value in that regard. I think there are some exciting targets that we already have lined up from the work that we've been doing over the last couple of years. So budget permitting, it would be great to run through the exploration process to ensure that we have our drill targets lined up. When I've talked to various people about financing, there's always a piece of curiosity that's tied to it. So that will come with budgeting considerations.
Okay, one more question has come in here. Do you, or I guess, would you consider talking to the EU for financing and offtakes?
I'm open to all possibilities. I want to build a company that provides value for shareholders. So I'm open to having those discussions. In terms of logistics, EU is a bit of it was a more challenging location. Not just it's way harder to get to, and therefore it's just more expensive to ship to. So I wouldn't say no. I think it's important to keep all your options open and have an understanding. And if it makes sense, then you explore that opportunity. So I'm definitely open to all conversations at this point, and the EU is certainly one of them.
There are no more questions at this time.
Okay, well, thank you all for joining. I really appreciate you taking the time. And if you have any other questions, please feel free to reach out.